This is a topic that is near and dear to my heart. We're going to talk about private equity and specifically the lower end of the lower middle market, micro private equity, search fund world. This is obviously something that Adventures does. We operate in this world, and I'm going to be bringing on Trish Higgins and Will Thorndike. If you guys want to come out and join me here. So Trish is the founder of Chenmark Capital, based out of Portland, Maine. Fascinating story. So have a seat, guys. So she and her husband and brother-in-law all working on Wall Street. And just doing great, and then decided up and moved to Maine.
Portland, Maine.
Portland, Maine.
The other Portland.
The other Portland. the more important Portland? Oh, no, I don't know. Anyway, and so Chenmark acquires micro companies. Yep. And helps operate them. Will has been really one of the, can I call you the godfather or godfathers of the search fund world?
Interesting connotations.
Yeah, exactly. Housatonic, based in Boston, private equity, but really, you're probably most well known, ironically, for writing like a definitive book on the private or the public markets, The Outsiders, which is just absolutely fantastic. And I feel like the breadth of what you do is just amazing. So anyway, I'm super excited to welcome them to stage. And maybe Trish, we can get kicked off by why don't you give us kind of a lay of the land in where private equity is, how you see things, how do you see you all fitting into that, and yeah, get us going.
Sure. So. First, thanks for having me here. I would say that we're very focused on micro PE. So all the stuff that Dan talked about in terms of like the tall, handsome guys is not my world. We are definitely dealing with, much smaller companies in I'd say much grittier environment. We purposely look for companies that are definitely below the radar of traditional private equity. A lot of that is based on, one, we don't really see ourselves having any competitive advantage in larger deals. We also don't have as much money as they do, which is a limiter, as well as valuations are very, very high, as Dan talked about, as well as the use of leverage is, very liberal in that space. But we really see that as soon as you start going above sort of $3 million of EBITDA, valuations just start to skyrocket. So we've found that sort of staying in the lower area, at least for the types of businesses that we look at, I know you've had a little bit of some different experiences, but at least in our case, we've found that if we stay below that, we generally can pay 3 to 5 times. Our target is really more around 4. Anytime we're above 4.5, we get like some heartburn.
So when you say 4.5, because I want to make sure everyone understands.
Yeah.
So are you talking about EBITDA, and do you guys normalize that at all? So when you think about, is it true free cash flow of the business, or how do you think about multiples related to operating the business?
Yeah, so I'm usually, when I say 4, I'm talking about EBITDA.
Okay.
No pro forma adjustments or anything of that nature.
This is actual real EBITDA.
Real EBITDA.
Wow.
Yeah.
Not community adjusted.
Not adjusted of any sort. True historical. Often we'll take like a 3-year average of EBITDA. Yes, actual numbers. And then it depends on the type of the business and how much CapEx it requires to continue growing on. But that's something that we think of. We'll look at it as like a multiple of free cash flow and a multiple of EBITDA, and usually the multiple of free cash flow can be like a little bit higher, depends on the type of business.
Interesting. Wait, Will, so why don't you talk about where do you see search funds kind of fitting into the PE landscape, and maybe you could talk all, kind of related to the multiples and kind of business models, maybe comparatively.
Yep. So search fund world has sort of exploded in the last decade or so. So in the last couple of years, there have been about 100 search funds raised. Roughly 3/4 of those sort of US-based, 25% outside the US. And that's an order of magnitude growth over 10 or 15 years ago. So, substantial growth. Search funds are generally fishing in the same pond that, Trish and James are in terms of size of company. So generally targeting businesses with $1.5 to $3 million of EBITDA. I would say EBITDA and free cash flow tend to be pretty close. The conversion rate is high for the kinds of businesses search funds are focusing on. We can talk more about that, but the kinds of businesses that search funds focus on have changed a lot in that same period of time, 10 or 15 years. So they tend to be buying growing, recurring revenue, asset-light businesses. that often have negative working capital and low CapEx. So EBITDA and free cash flow are often pretty similar. And if you looked over the last 5 years, sort of average multiples of EBITDA or free cash flow have been sort of 5.5-ish times, 5.5 to 6 times. But for businesses that are growing top line sort of 10 to 15%, right? So that would be sort of the rough parameters.
So that, I mean, doing the rough math, I mean, you're generating at least gross net of the fees, and I kind of want to talk about what that fee scrape looks like and how that works as the investor. But I mean, you're talking about really healthy returns in this segment on average.
Yep.
I'm sure there's outliers on both sides. Maybe you could talk a little bit about, as an investor in this space, what are the types of gross returns, net returns, and kind of what's the spread you expect in this space?
Yep. So I'm investing as an individual in these search funds. Our firm started investing in them, but as our fund sizes grew about 10 or 15 years ago, I'm predominantly investing as an individual. And so the Stanford Business School has a very thorough repository of returns data that they refresh every 2 years. The most recent iteration came out earlier this, I guess, fourth quarter of 18. So I think there's 100, at the end is 177 and growing, so it's pretty sizable. And so overall returns have been very good, and those are net returns to investors. So they've been sort of mid-30s across that group over pretty long holding periods, average 7-year hold. Okay. There's a dispersion in that data, though, and so you've got sort of the top quartile driving the lion's share of that alpha. We can talk more about that trend, but that's sort of. And then another trend in the industry is there are an increasing number of funds investing in search funds. So that gets to the fee scrape.
Yep.
So that 30-ish IRR would be gross to the funds. So net low to mid 20s to LPs. Yep. Kind of rough, super rough justice.
And how does debt play into that? I guess for both of you all, I mean, it's kind of a question, like how do you think about using debt as a lever for returns, and how important is it to the return profile? What kind of risk does that add to the business?
So I think our perspective is a little different because as a family, it's more important for us to make sure that we own the asset that we buy for 10, 20, 30 years than it is to maximize for return in any given period of time. So as a result, we sort of have tended towards having less leverage. So usually, would have sort of 2 times EBITDA at the start, and all of our models of a deal, all of our models focus on repaying cash as quickly as possible to get to kind of a no debt state with high levels of free cash flow we can deploy elsewhere. I know that that's not like the right thing to do, but when it's your own money and like your own night's sleep, like it works out well.
And you feel like these businesses can handle that type of debt load in a fairly straightforward way?
Yes. Yeah. From that would be our sort of peak debt load.
Gotcha.
And that's because we're trying to have enough to facilitate growth in purchasing companies and to build a portfolio, but not putting too much on they can't handle it. So we're not looking to optimize for returns through the use of leverage.
Gotcha.
And I'd say search funds would be a little bit more levered than that, Brent, but not much more. So 2 to 3 times debt would be typical. So less than 50% of enterprise value, at the transaction level. And so if you look at the components of that IRR, cash flow growth is the primary driver, followed by multiple expansion. Leverage is the third, which would be very different than the dynamic Dan was describing for the broader PE industry.
Right. Seems much more like a family business type operations. I mean, maybe a lot of these family businesses aren't putting on debt themselves. Obviously, search funds are primarily getting non-recourse debt, usually traditionally getting access to that. How much are you seeing any detonation amongst the search funds? I mean, is it pretty rare occurrence?
Detonation meaning
the business goes out. I mean, just
like that
blows
term.
up.
I like that term. Fortunately, there's been low level of
rapid disassembly.
Rapid disassembly has been relatively rare. Yeah, and that 2 to 3 times debt is typically bank debt is the majority of that, but there's often a slice of seller financing.
Sure.
And the seller financing is on very friendly sort of covenant terms, so that any issues with the lender are triggered at the bank level.
Yep.
And those are pretty rare. I would say that the community search fund investors over time, as they're sort of refining the model, have realized that covenant headroom is very valuable, very important, more so than rate. So we will trade, 100 or 200 basis points of rate for more headroom, particularly in the early years on covenants. Yeah.
It's really interesting, comparing what you just said with obviously what Dan said earlier. If you think about it, traditional PE is paying, call it double, if not even more, the multiples, and they're putting on twice as much on average, if not 3 times as much debt. I mean, you can see how the difference in detonation risk would be quite different.
Yeah.
So that's really interesting. So when you all think about the kind of the lower end in business models, you all, when I say you all, obviously you're financing these search funds. The businesses that you're looking at, my instinct is that they're very different than the types of businesses that you're looking at, or dissimilar in some ways. Maybe you all can talk about what's the core business models that you all like to explore, what's attractive, what's not attractive, and sort of why.
Yeah, so we look at things broadly, just because, one, I think we like looking at things broadly.
Sure.
And learning about different industries. And in this sort of micro-cap PE space, I'm sure there's industries like I don't even know exist yet.
Yeah. Oh, yeah.
And so I don't like closing myself off to those opportunities. To date, we have focused on industries where, sort of, as we put it, calling your customer back is a competitive advantage, which I'm sure you have experience
absolutely.
with.
The table stakes.
Exactly. So that lends itself to a lot of, home services, like sort of business services type areas that are highly fragmented, and where we feel like, we're not necessarily, tech experts or super, high, manufacturing process gurus or anything like that, but we do feel like we can bring sort of basic business 101 into our companies and help them be more enduring over time. And so we look for industries where like the standards are low in terms of general operating practices.
Like low professionalism.
Exactly.
Gotcha.
Which I think my understanding is probably a lot of what you look at as well.
I mean, I think in a lot of companies, I mean, we joke at Adventures that, small businesses don't say small on purpose. Mm-hmm. There's a reason why they're small.
Yep.
And typically, there's never a chance that you're going to meet a great business model with a great operator that stays at $3 million a year of free cash flow, right? And they're going to grow dramatically beyond that, unless there's some very strange limiting factor. And so, almost by definition, if you like the business model, there's going to be a lot of room for improvement. Now, the question is, it's hard, right? And I think it's easy as investors. I mean, I had a whole bunch of theses that I came into this. I'm like, you just tell people, like, why wouldn't we do this or why wouldn't we do that? It's a little bit different. And maybe we could just dive real quick into that of like, what are the things that you thought were going to be, Harvard MBA, you're working on Wall Street, you've got this thesis. What's the reality that you experienced that maybe is a little bit different than the thesis?
Yeah, I think a lot of lessons learned and still learning. But I'd say like there's 2 kind of big categories. One would be in terms of incentivizing people. I think that, I'm guessing everyone at this conference is a naturally driven person who feels like, hey, if I work hard at what I'm doing right now, I will make it to like the next ladder, and then I'll work hard, like rung, and then I'll work my way up, and that's just kind of like how you're all naturally wired. And like it turns out that in a lot of, especially more blue collar based businesses, our experience has been, a lot of people actually don't want more responsibility. A lot of people don't actually want to make more money. They don't want to work longer hours and move up. They're very happy in their comfort zone, and they just like their life the way it is. And so, in us coming through and saying, okay, this is great, we'll introduce, programs for professional development, incentive plans, kind of allow people to move up. That'll be a really big part of, the companies that we're building. Actually, like that introduces very large amounts of stress for some people to the point where they basically just break down and leave. Because you're saying, hey, instead of just being a crew member, like you could be a, crew leader. And a lot of people just actively don't want that. So, one of the things we've had to shift our thinking around is like, what do people actually want? And how do we make sure that there's opportunity for the people that want it? But if somebody doesn't, we can't really have, an up or out policy in our companies. We have to have opportunities for people to just, if you're a really good crew member and that's just like what you like doing, like I want you because you're actually very valuable to me.
Sure.
So things like that sound like really easy when you put it on a PowerPoint to be like, oh, this is like how we're going to manage our people. But then in reality, like a lot of that stuff breaks down.
Yeah, just too quick. So just going back on business model. So the search fund, the key learning in the search fund world has been that if you're pairing an super talented but early career CEO into a private company situation, 3 economic characteristics are really helpful, we found. So one is recurring revenue. And the rules of thumb around that are sort of 60 to 80% of the revenues being recurring with low churn. So preferably single-digit churn, customer churn, at least sub 20% churn. It's very helpful to be in a growing market. So markets where you've got sort of long-term secular growth that we sort of describe as 2 times GDP. So market growth of mid to high single digits or better. And then low capital intensity measured by returns on tangible capital, north of 20%. So if you're trying to put the early career CEO into a situation where they have the highest odds of success, and we found those parameters are helpful. And then in terms of characteristics that correlate with success in early career searchers, it's things like time management. So just being really, really laser focused on how you spend your time, trying to avoid spending time on sort of daily crises that aren't truly impactful for the business, sort of knowing what messes to step around, is what we say. Being willing to listen to your board members, first of all, identifying mentors, and then being willing to listen to them is really, and then time with customers. Early on in the first 12 months, spending time out talking to customers. So those things have, over time, just tended to correlate with early success in searches, and you guys have done those things in spades.
Maybe you could dive a little bit into the characteristics of this business. Is what are the industries or business models that fit most closely? What do you see the most searchers going after in terms of the types of businesses?
Yeah, they tend to be niche-oriented service businesses, providing some sort of essential service, usually to a growing end market.
Okay. So like, so give us an example of maybe a couple that you've worked with recently.
Yeah. So. Probably the most successful search fund ever is a company called Assurion, and it's just a good example of this. So Assurion began by providing roadside assistance service through cellular phone companies to their end customers. So if you signed up, this is beginning in the mid-'90s, they bought the company in the mid-'90s. If you were signing up for cellular service then, the reason you were doing it, the initial early adopters were business people. Following business people were people who were concerned about safety. And the cellular companies would run ads of people breaking down by the side of the road and being able to call. And so this was a captive AAA service that these guys offered through the cellular companies. It was $3 or $4 a month embedded in a much larger cell bill. They then moved from that into handset insurance. Same idea. So they were providing these essential services to a very fast-growing end industry. So it'd be an example.
Yeah, that's really interesting.
Did they know it was that fast-growing when they got into it?
So that it had good growth in sort of the 1 and 3 year periods leading up to it, but it would have been impossible to predict the 20-year trajectory.
Right.
But it was clearly a high growth opportunity.
Because it's like $1 billion company now,
It's a big company.
It was a crazy out. I mean,
it's crazy. It's the extreme example, but lots of the search fund companies fit that model of niche so growing end markets.
So when you think about you're taking a new CEO and you're putting them in. I mean, I'm sure Trish, you guys have experienced this in trying to get leadership into your companies, as well as you all being new into this. How does that relate to the cultures in these companies when they're first going in? So you have a seller that's maybe done things the same way for a real long time. Like, where are the friction points, and how typically do you all deal with it? How do your searchers deal with that in terms of maybe changing the culture over time? Taking the culture and making the best of it. I mean, how does that work for you all?
Yeah, so I'd say, again, an area where we still have a lot of learning to do, but to your point, like small businesses, these businesses are usually small for a reason. And it is often because the owner actually wants them to be small, because the owner has become, started in this company, grew it, to a level where they themselves are making more money than they ever thought they were going to, and they don't really want to do anything to risk that or to hamper their lifestyle. So they've said, hey, you know, I'm taking home this amount, it pays for my boat and my vacation house and my kids' college, and I'm good. And so sometimes, at least in the companies we've worked with, like the culture is oriented around not messing up the owner's income stream. And so, I mean, which is fair enough, right?
It's their business.
Exactly. And so for us, you know, when we first came in, we said, hey, you know, we just want to keep things the way they are and have these things continue to perform steadily. I think that and that means trying not to enact much culture change. I think we've started to realize that if you don't enact much culture change, then you continue to have the same performance you've had in the past, which isn't necessarily a good thing, because it also means that the types of things that I want to do, such as like use the internet in our companies, might not be welcome. And so we've actually sort of adopted our thinking to say, you know, when we first buy a company, it's more about outlining, like, these are the things that you have to do to be part of, like, the Chenmark family and group of companies, and that it's actually a lot easier to enact that change sort of early on than it is to kind of wait for things to settle and then try to change it.
Interesting. Well, what do you see?
Yeah, I'd say so completely agree with Trish. And ongoing seller involvement in any form is generally problematic. It's one sort of rule of thumb we've evolved over time. So maybe in 10 or 20% of the cases, there can be a truly productive relationship, but often that's just really hard. So just recognizing that and defining the seller role from day one very clearly is an important step. And then it's this tension between wanting to make change, any clear changes, you know, letting people go, do that early, but also cultural changes, we find generally it's better to let those unfold over time. So for the new CEO, particularly a younger CEO who's sort of learning in that role, sort of take 12 months before aggressively going after the culture.
So what's the underwriting process? I mean, because I'm thinking about in our businesses and obviously thinking about these smaller companies, there's a lot of institutional knowledge built into these sellers, right? And they're the leaders of the business. There's a leader for the reason they've been able to grow this business to whatever the state it's in. How do you underwrite for them, you know, exiting stage left, what seems like very quickly in a traditional search fund model, maybe a little less quickly with you all, but I'm making some assumptions. But how do you just even think about underwriting that? What are the things that people are asking, and how do you gather that sort of state of knowledge to be able to even know where you want to go with it?
So more often than not, the seller, who's typically the founder, fits the profile Trish just described, where they're sort of harvesting a large stream of cash flow, a larger stream than they could have anticipated when they founded the business, that's funding a comfortable lifestyle. And they're not in there driving the business 60 hours a week, typically.
Yeah.
So it isn't as though they're essential. So understanding what it is they're doing is really important. The riskiest situation is one where there's some customer concentration and the seller has those relationships. So that's the truly risky situation where there has to be a clear transition and the seller role needs to be defined, and those deals have to be just held to a higher bar.
I was going to say, so when you're counseling searchers in that, you know, I assume that's a fairly common thing that somebody would bring you a deal and say, this is something that I think we can mitigate through, and obviously you've seen this movie before. So how do you talk to your searchers about that? Like, where's the friction maybe between what you want to fund and what they want to do, and kind of where does that come down?
Specifically relative to the seller role?
Yeah, or just seller role, or really anything in general. I'm just curious. There's always this interesting tension, I'm sure, between you have this incredible experience. You've seen these, you know, over and over and over again, what works and what doesn't. I'm sure you're pattern matching, and you have these first time guys that are out there, they're trying to, you know, get something done. Like, this is their whole livelihood. They got a short period of time to get something done. I'm sure there's got to be friction and clashes between that. And I'm sure that maybe customer concentration or seller role might be one of them where you all disagree. I'm just curious where those disagreements are. Yep.
So seller role that's a recurring topic that comes up, and I think the investor community generally is just skeptical of meaningful ongoing seller roles. That would be a flashing yellow light. And there is sort of potential for misalignment and incentives in the typical search fund as you get further along in the search period. You know, towards the back end of the search, you know, the searcher has an incentive to get a transaction done, and the investors obviously only want a really good transaction to get done. So I think, but generally the The specific areas of focus are in the core model, the base case model, avoiding multiple expansion at all costs, making sure that the growth assumptions are consistent with history, both in terms of unit assumptions and pricing assumptions and revenue, and sort of no aggressive assumptions around margin expansion going forward. So just sort of common sense issues, and then a lot of discussion of kind of customer churn dynamics and really understanding those. So those would be common areas I think investors typically laser.
Yeah, it's really interesting. So Trish, so how do you all think about that when you're coming into these companies, and both the good and the bad of having sellers more involved or less involved?
So we have had mixed experiences, which there's a lot.
Welcome to the club.
There's a lot in that statement. But I think part of it is like every owner believes they're the most important, usually the most important person, and that if they're not there, like everything will crumble. And
that's not always true?
It turns out that is not always true.
Gosh.
So a lot of it is just spending time with the seller, as well as trying to understand, spend time with other people in the business before you do a transaction, to say, really figure out, like, what are you actually doing all day? And are you, like, there are definitely some cases we've seen where, like, the owner leaves, and because we have some situations where a second in command will sort of step up into the CEO role, and that they're like, thank goodness, because there's been like things that we've all wanted to do for the last 5 years that we couldn't do because the owner didn't want to do them, but like, can we do them now, please?
Sure.
And so it's almost like a weight has been lifted off of the company. And so it's about spending a lot of time with people beforehand to try to understand as best as you can the dynamics. I think that in the situations where we've had to have the owner, leave the company, there is definitely a moment that feels very similar to the same moment when you increase prices on customers, where everyone tells you that you can't do that because all of your customers will leave you immediately.
Yep.
And it turns out that some of them kind of grumble a little bit, and then they all kind of accept it. I think that when you have an owner who's leaving the business, and you try to have them leave on good terms, so you can call them to ask random questions. But, there's a moment of high anxiety when you feel like all of your customers might leave you, and then you try to over-communicate and over-service, and just sort of, it turns out a lot of people are just using that company because they provided a good service. And so as long as you can continue to provide the good service, it just all kind of goes away. So it's one of those like acute moments, and then it's over. And so for us, we've kind of adopted the approach of saying, like, you can't be so scared of the owners not being involved that it, actually, like, you avoid making those difficult decisions. So it's better just to do it, manage your way through it, and kind of move on.
I'm sure there's lots of situations out there, if you don't choose wisely, where if you did that exact thing, the company would crumble. Mm-hmm. How do you all think about underwriting that risk of, I call it detonation risk. That's what we always think about, the ultimate downside of the company just, loses a ton of its customers, loses big customers. So how do you think about picking and choosing the right companies to be able to do that with versus not?
Yeah, I don't think we haven't or wouldn't really seriously look at doing a deal where the owner is the only point of contact with like the main customers.
Sure.
To us, that's just, there's so much there that's uncertain for us, and we see enough opportunities that we just don't do that.
And it is the reason, Brent, that recurring revenue is the first of those characteristics. Is they really resilient business models lend themselves well to inexperienced CEOs, and they give you some detonation buffer.
Sure.
Inherently. So that's a primary criterion.
Well, so let's say the company gets through. So Searcher finds its business, successfully transitions. You all successfully transition leadership. How do you all think about redundancy being built into these companies, hit by a bus risk, whatever you want to call it, amongst the leadership of these companies? How do you plan for people getting sick, people potentially having an issue, that takes them out of the job for a period of time, or maybe even permanently? And how much are you planning in creating that redundancy in the companies?
So, day one, it doesn't exist,
yep.
Right? Because we've called up the people on the bench to be the leaders. So it's something that we have to focus on developing. So part of it is us getting to know the people in the companies and kind of know where the talents, the pockets of talent are, and try to invest in those people so that they could step into certain roles over time. But I'd say, it's an area where, if, for instance, in one of our companies, we had to part ways with the CEO, and so our third partner, Palmer, is now the CEO of that company, because we said, there's really nobody internally that, maybe over time they could step into it, but day one, we just don't
You're
really
building
think.
a bench at the Chinmark level that you can parachute people in opportunistically over time.
Yep.
Is that anything in Houstonic, when you guys were doing as a firm, or anything that you all have a network of people that you can kind of?
I would say in the search fund world, Brent, there's you've got the searcher dropping in, typically replacing an owner who has not been full-time, and then you've got the next level of sort of functional management, and there are usually one or two people in that layer who could likely fill a stopgap measure if the CEO didn't work out. And then at the board level, there are always two or three recently exited CEO types who are sort of operating mentors for the searcher, who also could play some, and have in some cases played some sort of a temporary role in helping run things while a search was conducted for a replacement.
So maybe let's talk about that. Boards of directors, outside counsel. How do you all think about that? In your different models. How important is it? What are those skill sets? What is the role of any board or advisors to the business? And has that evolved over time?
I'll take a quick crack at that.
Yeah,
So in the search world, that's boards are critically important. Almost impossible to overstate how important they are. So, and the sort of key design principles there, I think, are small-ish boards, sort of a maximum of 5.
Okay.
And a mix of the sort of non-CEO board members split between operating, people with relevant operating experience who can help mitigate the inexperienced risk of the CEO, and then investors who have experience investing in similar companies. And operating experience, what we're generally looking for there isn't someone who's been involved with the larger company, publicly traded, well-known company in the same industry. It's someone who's run a similar-sized business with similar economic characteristics and leverage characteristics and grown it over time. That set of skills tends to be most helpful to the CEO, incoming new CEO.
So the board members, you said no more than 5. Are these all investors in the company, or some of the outside? And how do you think about compensating them? How do you think about involvement? How does that all work?
It's a great question. So they're generally all investors.
Okay.
Occasionally there'll be one who is not. And their primary form of compensation is the appreciation on their investment. So they often get an over-allocation in a deal where there's scarcity. Again, this is pro rata distribution relative to ownership of the search fund. So they have the opportunity to invest more equity if they want to. They're nominal board fees, but there's not an equity component to board compensation per se.
So over time, on let's say a week-to-week or month-to-month basis, are they proactively going into these companies and sort of, requesting things and having, hey, I want you to show me this or show me that? Or is it more of a reactive role where they're a sounding board on an as-needed basis? Or does it vary?
It varies. It's generally more the latter. It's more reactive. But in the first 12 to 24 months, more active.
Okay.
So there's typically sort of a pattern to these boards where the boards, particularly the board members with operating experience, are more involved in the early years, on site occasionally, but over time they move to more of a reactive quarterly board meeting cycle, with regular interactions between meetings as needed.
Interesting. So how do you all think about this?
It's pretty straightforward. We don't have a board. So, but I actually think that I think we could have avoided a lot of the mistakes that we have made if we did have a board that could have said, hey, I've seen this story before, and you should not feel scared to make that decision or this or that. So I think it's something that we probably will have in the future.
How are you thinking about that?
Slowly.
Yeah. Got a few other things going on.
Yeah, other things going on, and then it's partly I think all of us don't feel like we need to have a board for the sake of having a board.
Yep.
So
And these guys are doing a pretty great job as is. So, yeah.
So
I agree.
so some of it is just like who are the right people? How do we kind of think about that? I think we all sort of informally have our own network of people that we reach out to for advice. And so how do you think about bringing people in that, have that right mix of skills for where we are right now? So I think it's something we're just thinking about, but we haven't really, we have no strategic plan.
I'm right there with you. We transparently, we struggle with this exact same thing. That's why I'm curious. I really wanted to, we'll probably have to sidebar and dig in on that, Will, off stage. But we've really struggled with this too. We don't have boards for any of our companies. And I mean, certainly we made mistakes that, in hindsight are obvious.
Yeah.
And, is the juice worth the squeeze? And how do you incentivize people?
But Brent, you guys are typically, you're buying the company and the incumbent CEO is running it.
Correct.
Yeah, okay, so that's just a different, in terms of the board, it's just a different dynamic.
Yeah, it is a very different dynamic. But I do think this outside advice and having people that have seen a lot of these movies before would be helpful. So let's talk about what happens when things go wrong, because I'm sure you've seen plenty of stuff go wrong. I know for sure we've had plenty of stuff go wrong.
Yeah.
So talk about what are some of the key things that you see go repeatedly wrong? How are you dealing with those? How do you risk mitigate against those things? How do you think about it?
So in terms of, I think the thing that there's the crisis moments where it's obvious everything's going wrong, but I actually think that your point on time management is huge, because I think things can really go wrong on a minute by minute time allocation, on are you spending your time actually working on the things that are going to move your business forward, or are you just responding to whatever fire of the day has come up, or whoever is yelling the loudest. And so I think the big thing is figuring out where are we trying to go and spend your time doing that stuff every day. And I'm sure things come up every day that are a distraction.
Yep.
And so being able to to me, I feel when things are really going wrong, where it's hey, we just spent the last month and we didn't actually make progress on anything, and I feel things aren't flowing properly. So those are that's the sort of everyday, sort of slowly degrading things are going wrong. In terms of the big moments, I mean, those are, for us, have been more, for where we are at a stage of a company right now. I think we're really kind of trying to define who we are and what we stand for. So the most difficult things have been when we've had people in our company who have done things that don't align with our set of values, and trying to figure out what to do, when to take action, when to say, it's okay and move on, versus when to make a difficult decision to, terminate someone, especially if you don't have a lot of management depth and things like that. That's where, that causes the most amount of sort of internal sort of stress and distraction. And then usually there's some sort of financial component around that of hey, this company's not performing well, and it turns out that, the people in the company aren't, necessarily doing things the way you want things to be done.
Sure.
So for us, it's just kind of hunker down, try to stay true to who we are, make the hard decisions, and manage through.
What do you see in your?
Yeah, I would say, Brent, so when things go wrong, it's either we were wrong about the thesis on the business, or there are issues with the new CEO coming down the learning curve. Right? So generally it falls into either of those two buckets. If it's the former, that's a big problem. And it almost immediately means it's probably not a good candidate for a search fund deal, right? Because it's sort of, if you're really wrong about that, you're probably in more of a turnaround kind of a mode, crisis management, short-term optimization mode to service your debt or whatever. And so often the search CEO isn't the right person to operate well in that environment. So that's sort of one set of ways things can go wrong. On the CEO side, it is generally related to time management. And it comes down to that sort of Eisenhower matrix you guys have probably seen. But I think one of the key roles of any board, maybe particularly in a search fund company, is to make sure the CEO is spending enough time in the important, non-urgent quadrant. Right? That's sort of the role of board meetings is, okay, so we want you spending half of your time on these three things that they're just not going to be part of the daily crises coming out of the business, But you've got to spend 50% of your time on that. But it's hard to do that. It's easy to intellectualize that. It's hard to, that we use that of stepping around the messes that inevitably arise. And that CEOs who can't do that often end up not being able to succeed.
Yeah, it's amazing the imagination that I have to have about what can go wrong. It never fails to amaze me. I remember the first time we got the call that somebody had had a bathroom accident in somebody's backyard, one of our portfolio companies, and said, "Excuse me?" And there's like, "No, somebody literally pooped in somebody's backyard, and it's on camera." I was like, well, that's an oh shit moment for sure. So in the audience here, we've got a few minutes left. Everyone's thinking, okay, these returns sound amazing. Obviously, it sounds harder than it probably looks. How does somebody who is not in this world start accessing the types of returns? How should they think about going about building their own systems, whether they want to directly deploy into this area of the market, or maybe go through more of a search fund model? How do you think about that?
Well, I do think it is a lot. I think I've talked to a lot of people who say, hey, I want to start my own firm to, buy these companies and help operate them and kind of, and I do think it is hard, and it takes a while to get going. So I think that you have to enjoy spending your time doing those sorts of things, regardless of investment returns. Because investment returns are sometime in the future, but your day to day and how you're going to spend it is important. So for us, we're lucky because we actually enjoy that.
Yeah.
So we would
making the internet work.
Exactly.
Gotcha.
Right. So those are things that I think you have to, if you're going to be this is what I want to do myself. If you say you know what, I actually kind of like my creature comforts, and I actually don't necessarily want to spend my days sort of in the grind of a small business, then I think that you're obviously the search fund godfather, so you can talk a lot much more about that. But then I do think there are limited capital allocation opportunities in the space. So either you can give all of your money to Brent, which you can do, or I think you have to find somebody to execute it for you.
Sure. What do you think?
It's hard. We've been talking about returns, but of 100 search funds raised in a given year, only 70 find companies. So 30% don't find companies. And we were talking about this, last night, Brent. It's hard to spool up a search effort from scratch and try to find a company in 2.5 years from ground zero. So that is a hard thing to do. In terms of accessing accessing this sort of asset class, I think, the alternatives are, invest in one of the funds, and there are a growing number of funds. Brent, we're all fishing in Brent, you and search funds, and we're all in the same broad, very rich, what did you, 300?
Just huge.
300,000 plus, targets. So you can go through a fund structure, or you can take the time to network directly and try to develop relationships in sort of the search fund ecosystem or other related ecosystems. But that second path is much harder, right? So probably the most efficient thing is to try to find a fund that's already networked into these areas and out actively deploying capital.
I would just say in the last couple minutes here, maybe we could talk just about high level where you all see the future of this business going. Maybe we could talk a little bit about the changing dynamics of who owns these businesses and kind of what's coming down the pipe. How do you all think about that in terms of the opportunity set? Is it growing? Is it shrinking? Where's it going?
I'm obviously pretty all in on the opportunity set.
You moved to Maine.
Yeah. What I think is just you have more and more companies coming to market every year because baby boomers are aging, and so they're going to have to exit their business in some way. So I also like how diverse the opportunity set is. So kind of what makes sense for our model and what we're optimizing for might make a certain deal not work for us, but it might work for you.
Yeah.
Right? And so to me, there's still a lot of opportunity for different models to come into the space and sort of make it what they want it to be. I think it's so fragmented and inefficient that at the moment I can't really see there being, one huge powerhouse that dominates the market. I think in my sense there's probably a lot of different models, some of which don't even exist yet. They're starting to prop up, and that it'll my hope is that it ends up being sort of a little bit more robust than what it already is today, which is almost like a community of people who happen to own small businesses.
Well, how do you think about search funds? I mean, what's the future?
Yeah, I mean, one of the things that's interesting, Brent, is that I think there are structural reasons the inefficiency should persist.
Yep.
Basically diseconomies of scale. It's just hard to build large funds. They don't scale. And so that's intriguing. I think that's an interesting dynamic. I think one of the trends, within the search fund world, you're seeing these core funds that invest in search funds. You're seeing sort of a variant on that that's taking an accelerator format, sort of captive pools of capital. That's an interesting, and then there's sort of a nascent branch that's sort of backing searcher type entrepreneurs, but with much longer holding periods. I think that's a trend that'll be interesting to see both in this sort of lower end of the middle market, micro end of the middle market, as well as more broadly in PE. There's just a increasing move towards breaking the traditional fund life structure, looking at it more creatively and looking at longer lived permanent capital type structures. I think there'll be a lot more of that, and in this sector specifically.
Why do you think that's attractive? What's the thing? Why I think people are talking more and more about permanent capital, more long-term dated capital. Why do you think that's come up, and why do you think it's important?
Well, I think one of the, and this goes a little bit, Dan touched on this in his presentation, but I think if you got a group of private equity GPs together over a couple of glasses of Beshore wine, I think, and you said, what are your greatest frustrations with the current model? I think they would tell you that it forces them systematically to sell their best companies.
Yep.
At the exact point in time when they know they're their best companies, when the flywheel is spinning, and to sell them either for fund life reasons or to do it, to dress things up in advance of fundraising. And so structures that allow you to sort of really let those run over long periods of time, I think are just inherently powerful, with all sorts of related things that come from that. But I think that's more of that.
Yeah.
And in this space, I'm sure you see this with owners, is that having long-term capital makes a difference.
Yeah.
So they don't want to sell to somebody who's just going to sell again.
Yep.
And that, allows you to have, they'll sell for sometimes, things that don't make sense from a financial perspective. They'll sell to you for less because of that reason.
Sure.
So I think there's
Absolutely.
that matters in this market.
Hey, this has been absolutely fantastic. Let's give a round of applause. Thank you so much. Thank you, Brent.